Hey guys, what's up and welcome back to The Success. Today we're taking a look at 9 things you didn't know about Warren Buffett's investment strategy. Warren Edward Buffett is an American business magnate, investor, speaker, and philanthropist who serves as the chairman and CEO of Berkshire Hathaway. He was born August 30th, 1930, which makes him 88 years old. His net worth is $80 billion. He graduated from Columbia Business School and is married to Astrid Menks. But guys, real quick, before we do start the countdown, I'd want you to hit that red subscribe button to enter our monthly shout-out giveaway. Just comment down below saying I subscribed and we'll enter you into the giveaway. Number 9. Warren Buffett almost sold all of his Berkshire shares for $11.50 in 1964. When Warren Buffett originally bought shares in a struggling textile manufacturer named Berkshire Hathaway in 1962, he was simply trying to make a quick profit, not take over the company and grow it into a conglomerate. In 1964, Berkshire offered to buy back Buffett's shares for $11.50, which would result in a gain of more than 50%, and Buffett accepted. However, when Buffett received a written offer, it was for $11.37 per share, which would still result in a strong gain. Buffett became so infuriated that not only did he refuse to sell, but he bought enough Berkshire stock to take control of the company and fire the manager who refused to honor the original agreement. Berkshire's shares are worth approximately $275,000 each as I read this. Surprisingly, Buffett has referred to his takeover of Berkshire as the worst investment he's ever made. Number 8. Buffett invests in a personal portfolio as well as through Berkshire. The vast majority, about 99% of Buffett's wealth is in Berkshire Hathaway stock, and generally, when you read about Buffett stocks, you're actually reading about stocks Buffett or his team have purchased for Berkshire Hathaway's portfolio. However, Buffett does maintain a personal stock portfolio that's worth a significant amount of money. He rarely discusses investments in his personal portfolio, but we do know a few. Major Berkshire holding Wells Fargo is also one of Buffett's personal holdings, as is real estate investment trust Saratoga Growth Properties. Buffett has said that the stocks he holds are similar in nature to what he would buy for Berkshire, but he holds some that wouldn't make the cut based on size. Saratoga is a good example of this. Number 7. People have paid millions for lunch with Buffett. Warren Buffett has donated more than $30 billion to charitable organizations over the years and is planning to give away substantially all of his remaining wealth. As part of his philanthropy, Buffett auctions off a lunch with himself every year to benefit anti-poverty charity Glide. The auctions, which were an idea of Buffett's late wife Susie in 2000, give the winner a lunch for themselves and up to 7 friends with Buffett at the Smith & Wollensky Steakhouse in New York City. The bids regularly extended into the millions. The 2017 winner paid $2.68 million for the lunch, and 2016's winner paid $3.4 million. In all, the auctions have generated over $26 million for the foundation. Number 6. Buffett stocks pay more than $6,700 in dividend income per minute. During the second quarter of 2017, Berkshire Hathaway stock portfolio generated about $882 million in dividend income, which translates to about $6,731 in dividend income per minute. Much of this amount came from Berkshire's largest stock holdings, including $148 million from Coca-Cola, $182 million from Wells Fargo, and more than $195 million from Kraft Heinz. Buffett loves dividend stocks, especially those that consistently raise their payouts, as they generate a reliable stream of cash that Berkshire can put to work in any way management sees fit. Number 5. Buffett regularly does poorly during great years for the stock market. You might be surprised to learn that Berkshire regularly underperforms the market in years when the stock market is soaring. For example, when the S&P 500 jumped by 29% in 2003, Berkshire stock rose by less than 16%. When the S&P rebounded nearly 27% from the financial crisis in 2009, Berkshire gained less than 3%. Buffett openly acknowledges that Berkshire will often fail to beat the market during its best years. However, Berkshire's long-term success is due to beating the market when times are tough. Consider this impressive statistic. Since 1965, the S&P has finished the year with negative total returns 11 times. In these 11 years, Berkshire outperformed the S&P 9 times, often by impressive margins. In 2000, as the dot-com bubble started to burst, the S&P 500's total return was negative 9.1%. On the other hand, Berkshire gained nearly 27% that year. The company also beat the falling market in 2001 and 2002. In investing, a smart defensive strategy can generate far superior gains to an aggressive one, and Berkshire's track record is proof of this. In fact, while the S&P 500 generated total returns of 12,717% from 1964 through 2016, Berkshire returned a staggering 1,972,595%, despite underperforming the market several years along the way. Number 4. Strategy. The Warren Buffett strategy is a long-term value investing approach passed down from Benjamin Graham's School of Value. Buffett is considered to be one of the greatest investors of all time. His investing strategy, value, and principles can be used to help investors make good investment decisions. Number 3. Value investing. There are a few things worth noting about Buffett's interpretation of value investing that may surprise you. Like many successful formulas, Buffett's look simple, but simple does not mean easy. To guide him in his decisions, Buffett uses 12 investing tenets, or key considerations, which are categorized in the areas of business, management, financial measures, and value. Buffett's tenets may sound cliche and easy to understand, but they can be very difficult to execute. For example, one tenet asks if management is candid with shareholders. Conversely, there are interesting examples of the reverse. Concepts that appear complex yet are easy to execute, such as economic value added, or EVA. The full calculation of EVA is not easy to comprehend, and the explanation of EVA tends to be complex. But once you understand that EVA is a laundry list of adjustments, it is fairly easy to calculate EVA for any company. Number 2. How to invest like Warren. Buffett is not an investor, he is an owner. An investor is a teacher who puts $100 a month into a mutual fund, or a salesman who takes his $2,500 bonus and buys Apple stock instead of going on vacation. An investor is the accountant who has 5% taken out of her paycheck to invest in her company's 401k plans. That is not what Buffett does. Warren Buffett buys enough stock to have himself placed on the boards of companies. Even in the beginning, when he was not quite a millionaire, the investment partnership he ran bought into a company called Sanborn Map Company, where he was made a board member. When you are a board member of any company, you can guide the company's direction and the hiring or replacing of CEOs and CFOs. But this is not what you and I can do. You will not end up on the board of a publicly traded company by investing $100, $200, or even $1,000 at a time. This point is important for 2 reasons. First, it takes some of the glow and allure away from what Buffett does. He does not just find an undervalued company, buy it, and sit back in Omaha to count the money he makes. Yes, he is meticulous about the companies he buys. However, early in his career, he got into trenches, so to speak, and he had an active hand in what many companies he invested in were doing. Second, it emphasizes the fact that if you want wealth, you must be an owner. It's true that you can save and invest a little over the long haul, and if we do not have a market crash like in 1987, late 2000, or 2008, then you might end up with a couple $1,000,000 at age 65. If, however, you want that cash a bit sooner, then the best way is to own or be involved in ownership of a business. Number 1. Buy and hold. Buffett is used as an example by the media and financial advisors of why you should buy and hold, but the portrayal isn't really accurate. When you buy and hold a stock, you buy it and hold it no matter what. It does not matter if there is good news or bad news, a Democrat or Republican president, a recession or an economic boom. You hold the stock through good times and bad. Buffett, on the other hand, buys for specific reasons, and when those reasons are no longer present, he sells. Known as a value investor, one who buys stock that have a low price to earnings ratio, Buffett looks for good prices, sound management, and a competitive advantage. For example, in a 1996 letter to shareholders, he cited GM, Sears, and IBM as companies that were great, but could not stay competitive in their marketplace, and so they would have been companies to dump out of a portfolio. Buying a stock and holding it forever is not what the Sage of Omaha does. Of the first 20 companies in which Buffett invested, the only one he still holds is Berkshire Hathaway, and that is probably only for its name. Each of the 19 he no longer owns, yet we have writers, financial advisors, business news heads, and self-proclaimed investment educators who tell you to do just that. But if the world's richest investor does not do that, why should you? Alright guys, this brings us to the end of our video. I hope you enjoyed. Hit like if you did, and please do not forget to subscribe to our channel so you don't miss any of our videos in the future. Also guys, if you could please check out one of the 2 videos you're seeing on screen right now, it really helps us out. With that being said, I'll see you in the next video.